Data Leadership Lessons podcast. I'm your host, Anthony J. Algman. Data is everywhere in our businesses, and it takes leadership to make the most of it. We bring you the people, stories, and lessons to help you become a data leader. Our show is produced by Algman Business Media, where we make having your own podcast as easy as joining a video call and sending an email. At Algman Business Media, the stage is yours. Learn more at algman.com. Today on Data Leadership Lessons, we welcome Jim Barnish. Jim has spent the last 2 decades as a serial entrepreneur, operator, investor, and M&A expert. He now runs Orchid Black, a boutique growth services firm complete with former CEOs, CXOs, and strategy consultants. Jim, welcome to the show.
Thanks, Anthony. Super excited to talk data and leadership.
Awesome. So we had a great call on our prep session. So I can't wait to have this conversation with you today. So why don't we start like we do with all of our first time guests? Just take a moment, give the audience a little bit of your background, tell the story of your career and kind of what led you up to doing what you do now.
Yeah, absolutely. As you mentioned, the last 2 decades have been full of a bunch of different roles. Throughout all those years, I working in and on businesses, ultimately had an incredible amount of hard work, failure, family squabbles, data, leadership, all sorts of failure, failed acquisitions, failed growth, you name it. But no matter the role that I had, all of the growth stage technology companies, which is where I focused, all seem to struggle with the same things, the same obstacles towards growth and value creation. And they all seem to hit similar inflection points around growth. And so ultimately, there was this commonality and this drive that was always kind of instilled in me around growth stage companies and how to really improve a methodology around helping them succeed. So as I kind of navigated my way through about 45 investments or buy-side transactions, few exits, a bunch of value, and a lot of failures again, it really kind of instilled in me as I worked the last decade or so with my co-founder now at Orchid Black, Stephen Horowitz, that there had to be a better way to get to these successes versus just having to live through all the failure, right? There had to be some stories and some methodologies and some data-driven, focused initiatives that could help companies succeed in a more meaningful and data-driven way and ultimately become worth so much more in the process. And so, really spent a lot of time with Stephen, dialing in on the data from the companies we had worked with, from other companies to see, what were the commonalities of making these companies worth so much more. And we've developed a methodology. Our clients kind of call it Miracle Grow for tech companies, if you will. But we just call it plain cracking the code on value creation and growth. Where at the end of the day, we're looking to help founders and companies succeed without having to experience all the failure along the way. And that's really what we're doing today at Orchid Black is working with companies, technology companies specifically in their growth stage to navigate those obstacles and execute alongside of them. And we're having a blast.
That's awesome. Well, you're speaking my language because I'm like, all right, use the data and find patterns about what's been successful. You've had all of these opportunities to go through it. You're looking at it. You're trying to figure out what separates that. I can think of so many different contexts in which that kind of analysis has led to great results. And so it seems like something that would obviously, help. How difficult was that to find? Like, was it staring you in the face, or was that something where like, wow, we did not expect this?
As most things that are super comprehensive yet need to be simplified are, there were some things that were staring us in the face, but most things just took time to analyze and form commonalities around, and ultimately leverage in the context of whatever use case we were driving with a company. But at the core of it, we knew that there needed to be an objective lens to view a company's full potential, and that there was nothing in the market that looked at a company in its growth stage from a 360 perspective. But that challenge was really our challenge at the end of the day, was to create something comprehensive yet simple. And these founders and growth stage companies cannot pay $1 million for an army of McKinsey or Big Three or Big Four consultants, right? They also can't wait months or years to get to the answer. And so we needed to find a way to be able to get to that answer within a few weeks. And ultimately something that was as cost effective as possible. And the answer ended up lying into something that I'm sure you'll love the description around, which is a value creation assessment, a data-driven assessment of any technology company in its growth stage that we find. And although we look at thousands of data points, right? Although we focus on a number of pain points that connect to those, ultimately there are a number of commonalities that allow us to pinpoint the primary opportunities for value creation in a data-driven way, and then work backwards from there to really spend a lot of time really spend a lot of energy and focus getting founders and companies to focus on doing the right things at the right time based on where they're at. And so that's kind of become our what, right? Our VCA, our value creation assessment, has become our what to diagnose companies. And then our team has become the how with the playbook that we've developed and our team of experienced operators who will not only give you the recommendations, but also help companies execute against them, because ultimately everyone needs to be hands-on in an early stage business.
Well, that's true.
Yeah.
So there's so many questions that I have right now. All right.
Shoot
So
'em.
the first question was one that I would have level set for the audience out there, is when you talk about growth stage companies, what exactly do you mean by growth stage companies? What constitutes a growth stage company?
The way that we constitute a growth stage company is a company that has at least $3 million in revenue. So they've shown some focus around product market fit, or that they've been able to drive some foundational revenue into the business. 3 million is a number that we picked based off of what makes the most sense for our methodology and our team to work in. But ultimately, growth stage is when you're in that stage where you've validated some foundational revenue points, you've gotten the point to what we would call product market fit, and you're now focused on driving efficiencies into the business that are helping it getting it to the next level, essentially. And so, our method is working with companies that are starting between 3 million and 50 million. So not too late stage, not too early stage. And companies that are typically struggling to take the business to the next level beyond that initial product market fit.
Right. So in the analysis that you're doing, is it largely a financial analysis, or how do you fold in kind of the magic side of what the organization actually is doing and what their potential is? Because that, I imagine, that's not always evident from financial analysis.
Yeah, it's absolutely not always evident from financial analysis, although financial analysis is a big part of it. And you see, before I get to your question, you'll see as you analyze the growth stage company landscape, where a lot of different stakeholders play: private equity, venture capital, right, general consultants, a lot of different folks. Ultimately, there's a lot of commonalities on focusing on the financial aspect, right? What we were unable to find in the marketplace, and why we really knew we just needed to start Orchid Black, was there was nothing that looked at it from a 360 view, right? So as you're building a business, you create a strategy, right? You hire talent to that strategy. That talent develops a product or service, right? That product or service drives revenue. And then there's operations that are supporting the company. Well, financial analysis is really focused on only the bottom two, operations and revenue, right? You have your financial statements, right? You have your general focus around growth and your growth plan from a metric driven perspective, where you're focused and your quality of revenue, things like that. But what about all the other elements in a company that are driving value creation, and most importantly, that are driving either alignment or misalignment around a plan? And that's where we focus. We focus on strategy, talent, product, revenue, and operations, right? Not just operations and revenue. And by doing that, we're able to really look at the transferable value that a company can have, whether it's going to be transferable to an acquirer or just transferable as we're looking at it from a market perspective of where the biggest opportunity for these companies to grow is. And so that's really what the fundamental basis around it is it's a 360 angle, because talent is just as important as strategy, which is just as important as revenue. Different elements and different focuses at different stages of a business, of course, but all are very important towards understanding where the company should be positioned, and also what the company needs to do going forward from an alignment and then a growth perspective. And so that's really the difference, is it's well beyond just financial analysis. It's looking at, everything in the business that's driving where the financial analysis is at. That's what gets us just really amped up around driving growth within businesses, if you can't tell.
Yeah, no, I love your passion for this. I can tell that it's something that you're very into, which I can totally appreciate and relate to. So for the data management people out there, I have to ask you. So the you're talking about companies that start at $3 million in revenue or what have you. And to be fair, I've worked with $3 billion revenue companies that had far more of their business on spreadsheets than they should have had. I know that a lot of small and mid-market organizations have not necessarily the most robust data capture and data management systems or processes internally. How do you compile this information? Like, how do you get and even figure out how to make some sort of apples to apples comparison so you can plug in a methodology? It's just like, in my mind, it feels like they're all wildly different. How do you do that?
So let me just walk you through a use case that might really make it evident. So we were called into a software company by a founder who had bootstrapped for about a decade and built an amazing business, quite frankly, but was starting to flatline. He wanted to exit within the next year or so and spend his time doing other things like advising other startups, enjoying life more than he had traditionally on the personal side, a number of things. But ultimately, because he had very low new logo growth, very low growth across the board, actually, the valuation that he got offered in the market was nowhere near what he expected. He had tried his usual ideas to generate sales, but things just weren't working like they used to. And so his next 12-month forecast, as he looked at it, was only making matters worse, right? If he was not growing and he was spending more money to try to grow, ultimately, his growth was lower and his profitability was lower as well. And so, he was recommended by one of his advisors to bring in Orchid Black to help. We ran our value creation assessment process on the company in a couple weeks. And ultimately, that process was super important and fundamental towards uncovering a number of things. We did a customer analysis that helped him really understand who his customer was, because it had evolved since the last time that he had done one. There was a lot of things, a lot of areas of opportunity, like pricing and areas of growth, tangential market growth even, that we were able to take advantage of simply by finding and understanding who this customer base had become and common attributes within that customer base. He had not really taken a look at market opportunities aside from the one that he was serving. There were tangential market opportunities that we could take advantage of as well. And so, between these items and his excitement, if you will, coming out of that VCA process, our team was kind of dropped in almost as a SWAT team of growth, if you will, for the next 7 months. And over that 7-month period of time, we actually increased the value of that business by 55%. Now, that didn't mean growing the business by 55%, but the valuation of that business was increased by 55% because we, number one, grew the business. We, number two, focused on areas of the opportunity that were beyond just revenue growth. And number three, because we had all this data at our fingertips, which we leverage in, kind of some formulaic IP that we've developed, right? It's not just, throwing data out there and data entry. It's leveraging best practices and IP that's been developed over the years. But ultimately, using these analyses, using this VCA process, we were able to help him win big, which is why founders, one of the reasons that founders, aside from the mission, go out to start businesses in the first place is to win big and create legacy and do really fun things and create meaningful things for lots of people. And so ultimately, the intake process of that of that VCA was similar in some ways to due diligence, but expanded beyond typical due diligence that made it much more operational and measurement driven than a typical due diligence process would be. And so it was, it's just a really exciting, it's really exciting seeing some of these founders, their eyes open to their own businesses, the same way that, you get excited when anyone's learning something new, and you get excited about the opportunity that's uncovered through learning. And so, ultimately that's just what gets me amped up to wake up in the morning.
That's awesome. Do you guys always work for the growth firm themselves, or do you sometimes work for acquiring firms that are looking for, the diamonds in the rough of these organizations that just need to capitalize on it and evolve their business a bit, but there's opportunity there too?
Yeah, once in a while we'll work for a private equity firm or venture capital firm, or an acquiring firm that's looking to analyze potential investment opportunities. But those are typical, cash for service fee engagements. That's not why we do what we do, right? Our business model hinges on our ability to increase value within these companies. And so, what we love to do and why we do things direct in almost every aspect of what we do is we put our money where our mouth is around value creation. We will take the majority of our fees as something that's aligned in aligning our incentives to the company's performance, right? Typically equity or some sort of coverage to have a standing in the business or percentage of sales, right? Something that's aligned with what we're driving from a growth perspective. And that we found that the best way to do that is just to do things direct, have as minimal outside influences as possible, because it is such a sensitive engagement, it's such a sensitive relationship, if you will. And really putting the founders' priorities in the middle of it rather than on other firms.
Yeah, I mean, when you're dealing with, financial transactions, that's always going to be an emotional thing anyway. But on top of this, you're dealing with people's life's work and their legacy. Yeah. When you intertwine all of that, it is as emotional and as sensitive as it gets. And on top of that, you have the different people that are already working at the organization and the various stakeholders and the customers and all of that. It is under the best of circumstances a tricky road to travel, and so that is that's certainly something that you have to manage. But what's interesting to me, and one of the things that I've been thinking a lot about lately is this notion of alignment of incentives. And that's something where I think a lot of consulting out there tends to have, built-in conflicts of interest, let alone, misaligned incentives. But what I like about your business model is that you do have that alignment of incentives where, like, if you are successful in helping this organization do things, you're going to benefit, the client organization is going to benefit, and the acquiring firm is going to actually have a better risk understanding of what they're getting themselves into. And so that, to me, that's when business is at its finest, when really everybody stands to benefit who's involved in that transaction. And that I think is the right way of going about this. And that's something where, for folks out there that aren't really necessarily in the space, but are thinking about these kinds of things, think about how can you in your business and whoever your customers are, how can you align those incentives in a way where you're growing that pie as opposed to trying to divvy up that pie and get the better of your client? Like, that to me is just no way to live. So I appreciate your guys' approach to this, because I do think, like, to your point earlier, these organizations can't hire the McKinseys of the world to advise them. And, they don't have the armies of lawyers most likely. And like, it's just, they need help and they need skills that, like, your organization has built from many transactions. This might be the one transaction they do. So it's definitely an interesting avenue to think about, even if we, many of us may never need this or may need this once in our careers. Right. So one question that I have is, does the nature of what the leadership of the organization is looking to do, whether it's to, exit, or whether they're just trying to get additional funding, or if they're trying to just get a valuation for other purposes like that, sometimes that's useful just in of itself, even if you don't do a transaction. Does that change your recommendations, or is what makes it good for one what makes it good for another?
It absolutely changes our recommendations. Most of the businesses that we engage with are looking to exit within the next 3 years. Most of the founders that we're engaging with, and so there's typically an exit on the horizon, whether that's in 6 or 7 months, like the example that I gave, or
Mm-hmm.
in 3 years. Either way, that's a major difference. And so, thinking on the 6 to 7 month side, right? It's more about cleanup, fundamentals, making sure that the business is not discounted for any major problems in the business, making sure to elevate and really position the company for exit. On the 3 year side, it's time. There's a lot more ability to focus on growth first, and areas of long term growth alongside of that, versus simply packaging something for an exit. And so, regardless of growth, regardless of exit timeline, if you just take out Orchid Black from the equation of what a business is just generally looking to do, there is always a number of options, right? Optionality, if you will, around what timeline, what level of investment, right? What area of opportunity and risk is going to be their data-driven roadmap, if you will, towards success. And one path is not typically the only path, right? There's the most costly path. There's the longest timeline path, right? And then there's a number of different things that will drive that optionality. But it is always, and always should be, the founder's interests in mind, rather than an outside individual or an outside firm, which is why we are so focused on founder goals, founder initiative, right? And ultimately setting the founder up for a successful outcome on the other side of, an exit in our case.
Right. I'm curious, and because you talked a little bit about how this corresponds or compares to like due diligences. And I've always had this thing in the back of my head, is that I've seen how due diligence efforts work, and I've always felt like they overlook how well an organization works with data. Like, do they have reasonable processes? Like you can often get like technology infrastructure as part of that, and like things that are a little bit more tangible, but something like, do they have reasonable data quality in what they're doing? I often see are not even articulated in a due diligence. Do you get into any of that, or do you factor in any of that, or is it just too difficult in the kind of timeframes that you work with to be able to actually assess? Oh,
absolutely. It's a huge part of what we look at. In fact, one of the I reckon exactly what you're mentioning, right? I spent about a year in the venture capital world prior to Orchid Black, and a little bit different of a problem set, but the main problem I had was we were always looking for our next unicorn, our next $1 billion company, our next 100x investment, and that puts a stress on a number of things. Number one, it focuses so much on the upside, on that 100x upside, that you ignore things that are going to make it a 10x versus a 1x. Number two, it focuses on infusions of capital to accelerate growth prior to validating that a company is ready for growth. And that's why 95, 96, I think, % of technology companies that have raised capital fail. That's a big number, right? And so if we focus on not only investor interest, but also founder interest, you start looking at things like, is the business sustainable for growth? And you can only find that through data. You start looking at things like, how are the operational processes within the organization capturing data from a single point of entry and making things as seamless as possible to leverage as few team members as possible, right? Things that ultimately translate to financial value, but at the stage that you're looking at them may or may not be reflected on any of the financial statements. It will be eventually, but when you backtrack it towards operational excellence, if you will, that's where we come in, right? We focus on helping companies not just grow fast, but also grow smart. And typically in venture capital, and also in many cases the private equity model, companies are sacrificing growing smart for growing fast, and eventually that catches up to you. You're ultimately wasting a lot of capital, and founders are getting diluted on their own cap tables because of how much capital they're needing to raise due to that strategy in many cases. And so the model in many cases is flawed. There's a time for venture capital money. There's a time, for not, but it's over leveraged in a lot of cases to be driving the wrong results, if that makes sense. Which again is why so many software companies end up failing. So, that mantra, grow smart and grow fast, is something that I really focus on. We really focus on as a company, and I think was a real gap in the marketplace.
Yeah, well, it's really interesting to hear this from your perspective, being in the space, because I've dabbled a little bit, but mostly I'm just projecting, and it's interesting to hear that, because I do think that your ability to work with data as an organization who is poised for rapid growth, it is a bit of a canary in the coal mine. If you don't use data well, your operational processes across the board are probably struggling.
Yeah.
Like if you don't know your own technology, I've worked with organizations that were software firms that had grown really quickly, but as I partnered with them or did consulting work for them, I learned that they had architecture underneath their snazzy user interfaces that was antiquated, like decade old, and way behind where the technology curve would be, but they would still be billing themselves as cutting edge. You realize, hey, they've put all of their energy into the flash and not enough into the substance, and you didn't know if they would ever get back to that, because it was like they were addicted to that high growth mentality, but didn't want to do the work. And that's when I see that, that's really concerning. I imagine you have similar examples where what you thought you were going to find as you looked underneath the covers, it wasn't that at all. Is there anything you can share? I don't want you to name any names or anything, but do you have any stories of things that really surprised you that you only found from digging into the data and understanding it, and then kind of chasing where that trail led you?
Yeah, I mean, almost all examples in many cases, because it's one thing to be the expert, but it's another thing to let data drive that expertise, and then apply that expertise and on top of the data, right? And so I think one area that is probably the biggest commonality of confusion within a lot of these growth stage companies is, if my revenue isn't growing, I've got a sales problem, right? And both as an operator, sometimes even as a consultant, and certainly as an investor as well, I've seen that that story a number of times, right? One perfect example is a company that was throwing several million into their sales team, right? And their sales team was a bunch of seasoned veterans, and there was no doubt across the board that this sales team was going to turn the organization around. Well, as we started to look at it during our initial VCA process, and we got engaged to figure out what to do with the sales team, we found out pretty quickly through data that it was a number of other things prior to getting to sales that was driving the lack of growth. Market positioning was not spot on from a messaging perspective. So we had not focused on the niche that we had created throughout the years, or the company was not focused on the niche that they had created throughout the years. And they were focused on too many different personas, too many different stakeholders, too many different end customers, where nobody actually understood what they did. And so that was then driving the wrong leads, which marketing in many cases, call them marketing qualified leads, was saying these are ready for the sales team. Ultimately, they were not, because they had not raised their hand for what we were actually able to offer them. And so when the sales team would get engaged, they would not, these qualified leads would not go anywhere. And so everyone in the organization was just blaming sales, right? These amazing sales guys should be doing better prospecting. They should be doing better selling. And the final part of that is that if you have the right sellers in the organization, you are compensating them very well, way too well, if they're prospecting as well. Sellers should not be doing their own prospecting. Sellers should be focused on closing deals, because that's what you hired them to do in the first place. Right. And so if you have the right methodologies in place that lead towards sales, right? If you have the right structure, the right data-driven methodology, if you will, best practices, you've got a system in place where sales is getting it once it's already qualified. And so due to poor positioning, right, due to poor messaging, and due to a disconnect between marketing and sales around what a true qualified lead or qualified opportunity is, there was a number of things that we needed to end up applying first, focusing on first, before we ended up, right sizing the sales team.
That's really interesting, and it gets me thinking too, because it's not just a sales problem, but it's a business strategy problem. And this is something that, like, I got to get on my soapbox for a moment, because that is, like, I'm so tired of seeing organizations that were very successful doing something, offering something in the marketplace, and then they grow to a certain size, and it's like they can't be bothered with what made them great in the first place, and they want to go do something like everybody else in the industry who's not as successful as they are, because it's easier. It's like, oh, they see other valuations or something like that. It's like stick with what you're good at. Stop trying to be everybody else. But it seems like you see that constantly. Like, I mean, I just have to admit right now, like, I do this podcast half as therapy, right? Like, I'm just kind of like, I have to vent about some of these things because it drives me nuts. Like, just, you've got a magic thing here happening with the growth of your business. Don't give up on what's made you unique to be like everybody else. And that, I imagine, comes up way more than it should from your particular perch.
Oh, it happens all the time, whether it's not nailing your niche initially or not sticking to your niche eventually, right? Because you absolutely know that the right thing to do is stick to it, right? If you look at another company, you'll be able to tell if they're not sticking to it. But in your own company, for your own clients, you try to take advantage of what you find at some point on your journey for some reason. You need a strategy to make sure you don't do that, and a focus to make sure you don't do that, right? Yeah. When you're the business owner, you oftentimes end up looking past it, right? Other companies can't do it. Apple doesn't sell actual apples or swimwear. Steakhouses don't sell organic food lines, right? But when it comes to ourselves, we ignore this intellectual honesty, this intellectual understanding of sticking to our lane. And so, and it's largely because we want to help people, right? And we want to turn more profitable or grow faster. But, we end up doing none of those things. In fact, we end up doing the opposite by not sticking to our niche. And you don't realize that in the moment unless you've got something, a strategy and checkpoints to make sure that you're really sticking to your guns, sticking to your niche. I've got hundreds of examples probably around that, because that's always almost always a pain point or a focus in almost all of our engagements, whether it's a $3 million company or a $50 million company. And it starts with really dialing on that popular pain, that recurring pain that need to have that aspirin rather than the vitamins that you're seeing along the way, right? The things that made you get to this point in the first place. And so, beyond that pain, connecting to that and sticking to that is everything. And companies just, seem to lose their way at some point on their journey if they're not careful.
Yeah. And I think you make a good point in there too. It's like, you want to help people. And so you want to be accommodating. And that is that slippery slope away from your core business, because you're trying to do well. I talk sometimes about, just because you mean well and you intend a certain thing doesn't mean it happens. You have to actually achieve what you're shooting to do, not just intending to achieve what you're shooting to do. And that is a very difficult thing when you're not removed enough sometimes from it. Like, to your point, that intellectual honesty is really difficult when you're in the fray. When you're in the middle of it all, it's very hard sometimes to know what direction you need to go. It's like getting lost in the forest. It's really, it's easy for us, it's easy for me to judge, you've got to have better strategy, you got to stay in your lane, and you got to invest in those things. But it is also very difficult. And I imagine, like, you're able to pinpoint where organizations do that because you bring in a more objective perspective from the outside. And this is actually something true of consulting in general, is that they often can see things that seem obvious once they're said, but impossible to know until then. And that's where it really, really makes a difference. And I think your business is especially well suited to doing that, because I think the kind of analysis that you're doing and the kind of approach that you're taking is often not going to be anything like what the leadership of those businesses are accustomed to doing themselves.
No, typically not at all. And I think even more so, given the recent things that we've seen around COVID-19 and the looming recession as well, right? But what's crazy is that history has shown that some of the best, most resilient companies, and ultimately the most impactful, were born out of crises like these, and new solutions were born out of crises like these. And so when we look at a business, right, we're not only focused on that growth, but on that lean, efficient operation that's going to weather things along those lines. And what's so cool, though, as it relates to both, the opportunities that present themselves in times like these, as well as that outside perspective, is that great opportunities always emerge during uncertain times like these, tumultuous times like these, right? It is these downturns can work incredibly well to create new strategies and do new things that are strategic, right, towards the business. Problem is, when the business is doing it itself, it often is not looking at the strategic angle. It's looking at the in the business opportunity to then move towards a different route around, an opportunity that presents itself with one customer, or an opportunity that presents itself with one prospect. When we're looking at it, right, and when we're focused on these creative problem solving, these new opportunities and new strategies for the business, we're able to absolutely, to your point, look at it from the outside lens and focus on sticking to their knitting, right? Sticking to their knitting and focusing on the market opportunity, not just a customer or prospect opportunity. Where are we able to take advantage of what's happening in the external environment to be able to take this company to the next level? And that is something that is probably the most fun, I think, that our team has in driving these new strategies, and then showing companies how they can be innovative, right? Do new things, but make sure that all ties back to the strategic value of your customer and where you're focused on growing and exiting your business. And that's really the fun part about the consulting lens, if you will.
Yeah, well, and it makes sense because you're dealing with whatever the circumstances are. Like in our pandemic situation, you're advising these businesses, and you're not dealing with time frames where you can wait and try to time the market until the market comes back. Like these are decisions that are going to happen, and the best thing you can do is just deal with whatever you're surrounded by market wise at that time. So it's 3 years. Yeah, maybe you have a little bit of timing option there, but most of these you probably don't. And even 3 years is probably not long enough to wait for an entire economic cycle that can last, a decade or more. And so it's interesting to think, okay, given what we know market wise, how do we optimize what you're doing in the context that we are currently in, which evolves over time? And that makes me wonder, like, how has your business, from the way you do your work, been impacted by like the COVID-19 pandemic, and has it made it harder or easier, or it just simply changed how you go about doing the work that you do? Because I imagine that under normal, quote unquote, normal circumstances, you'd probably want to have some like physical evaluation. Like with a due diligence, you're going to send a team out and you're going to walk the halls and talk to people, get a sense of that atmosphere. Today, that's not probably very possible. So how do you cope with that?
We're fortunate that we live in and focus on technology companies. So most of our clients are already more online, more remote, more creative, more agile than the competition, if you will, or than most markets, if you will. And so that's one thing we did and do have in our favor. Now, that being said, right, our connection to the external environment is still just as much out there, and our connection to needing to feel and get a sense of how things operate beyond the remote atmosphere is incredibly important. And so a few things. Number one, we really, did I say really? Really focus on team cohesiveness and the ability to operate remote, right? And the ability to not only have that remote operability, but also the systems in place to drive to drive general operational effectiveness and efficiencies in the business beyond that remote environment. So are these companies, leveraging the team in a more meaningful way as it relates to offsite retreats, right? Or are they focused on having these virtual virtual get-togethers to give people the feeling of connectivity, so that they're not having a bunch of people quit because they have this lack of connection to the rest of the team once they're onboarded, right? Do they have the right onboarding systems in place? Do they really focus on team building as a general philosophy, beyond just individual leadership? And so there's all these things that come to play as we're looking at and evaluating teams and processes. And I would say that because of how focused we've always been on remote teams, on teams that are able to operate in an environment that could be signaled by today's existing environment, it wasn't as much of a change for us in our operating as we looked at the looming recession or COVID-19 altogether. It was just a tilt on the lens that made it incredibly focused, a much more larger focus for us than simply it had been before. So it's certainly a lens that we'd always look through, but it definitely honed in on that lens, snipered in on that lens, if you will, as we entered COVID-19.
Sure. Yeah, no, that's really interesting. And so we only have a few minutes left. And one of the questions that I would have is do you have advice that is generally applicable? Because I imagine a lot of your work becomes very specific about what individual organizations should do in the technology space, especially in terms of growing valuation. But do you have some good rules of thumbs that entrepreneurs that are listening or watching this could start to think about and start doing, and then when the time is right, when they're looking to make an exit, they could give you a call at Orchid Black to amplify that? But I gotta imagine there's some things that they should be thinking about all the time.
Yeah, absolutely. And I'll try to keep it focused on not just the business level, but the individual as well. So number one, nail and focus on your niche, we talked about, right? Yeah. And this translates to, as an individual and at a company level, focusing on what you're great at and what you can bring to the world. Number two, learn how to attract and retain the right talent into your company and into your life. Because even as a founder, personal mindset and personal growth matter just as much as business growth if you're going to grow your business. That may sound silly, but it is 100% true, because founder burnout is a real thing if you're not careful. Number three, focus on improving yourself, not just your team, your company, other people, right? Sticking to that last thing I said around the attraction and retention of talent, evolve your own leadership competencies and your own personal development. Do things like get an executive coach. I'm a firm believer that every founder, every leader needs a coach. It is something that seems insane until you get one, and until you see the development and the progression of your own competencies in your own life. And so those three things, I would say, are kind of the core to everyone. Nail and focus on your niche. Number two, attract and retain the right talent into your company and life. And number three, focus on improving yourself, personal development, including getting a coach. I've had a number of different failures, a number of different successes along all three of those. But ultimately, all are incredibly important, no matter your role and no matter your industry.
I think that's wonderful advice, and that's something that I think many of us should really take to heart and move forward with. I think the coaching piece is certainly something that many of us probably think in the back of our head, well, that we probably should think about doing that. And many don't. And that's something that I think most of us should. So great advice. And unfortunately, this has flown by. We're out of time. Jim, thank you so much for joining us today and sharing your wisdom with us. This has been great.
You bet. And always remember, data is your friend.
Definitely. And thank you all for watching or listening today. You'll find more information in the show notes. Please remember to follow Data Leadership Lessons on YouTube or wherever you get your podcasts. If you enjoy the show, please rate and review and tell others about us. Learn more about data leadership with my book at dataleadershipbook.com and use promo code ALGMANDL at the Dataversity Online Training Center for 20% off your first purchase. Stay safe during these unusual times and go make an impact.